Hello everyone and welcome to your Glassnode video report for week 8, 2023. So we had a bit of technical difficulty last week, but we are back into the swing of things this week. We're going to be looking at two very interesting topics. When we looked at it back in week 6, we were talking about how the market was at a bit of a equilibrium point. It had returned to a level where many oscillators were around that 50% type mark. And that really told us that we'd kind of reverted back to at least from an on-chain perspective, something that was a little bit closer to a mean value. Now, with that, generally comes a change in investor behavior. People have clearly seen a 50% rally off the bottom. We've recently had inscriptions and ordinals come onto the scene for Bitcoin. So what we're going to do is look at how the investor behavior has changed. What is the overall behavior pattern shift now that we've had something that is a fairly substantial rally year to date? So we're going to look at this from two different angles. The first thing we're going to touch on is a bit of a view on inscriptions and some of the impact that that's had. Now, you will find in the description below a link to a very, very detailed report that we did. That was back when we were in the process of crossing 100,000 inscriptions. We are now up to 150,000 inscriptions as of the time of recording. I think it's even more than that now. I do recommend checking that report out. We went into a lot of depth understanding which types of inscriptions, how much data is it taking up, what are all those footprints. We will touch on some of the key elements here, but I would recommend checking out that report if you're curious about what ordinals and inscriptions actually are. We did do a detailed write-up on that. So that's the first angle we're going to look at. And the second one we're going to look at is breaking down the coin supply into our long and our short-term holder cohorts. Now, the vast majority of metrics that we look at today are going to be ready for advanced users. You'll see all of these supply metrics and various transaction volume metrics are available for our advanced members. And in the last chart, I'm going to give you a very, very quick snapshot for our professionals. We recently rolled out about 47 brand new metrics, which combine the goods. I mean, these are kind of my favorite tools: cohort analysis, long-term, short-term, realized profit and loss, capital flows and sentiment, and combining it with exchanges. So looking at long-term holder, transfer volume in profit to exchanges. Really, really cool stuff. Give you a very, very quick snapshot of what we've got in store for you there. But really, they're the kind of two angles we can look at it from the inscription side of things. And we're also going to look at it from this long-term, short-term overall behavior patterns. As always, before we jump in, please do give us a rate, a share, and a subscribe. It does help this get to more people. We are going dark mode and full screen, so let's get right into it. Okay, so here we are. We can just look at a standard price chart, but where's the fun in that? What we're actually going to look at here is look at a bit of a workbench construction, just to show some kind of tools that I use on a regular basis, just to make it a little bit more exciting. So the main point here from a price perspective is that we are clearly butting our head up against the top end of this range that we've been in since June. So over the last 8.4 months, and I can tell you it's 8.4 months because that's what this curve here is calculating, we have essentially been underneath our current price. So we are basically pushing up to an 8.4 month high as we speak. And this is essentially erased the FTX event, which we saw in January, and we've essentially come up and recuperated much of the losses that we saw through the last 8 months. So I've got here a couple of formulas. The first one is using the value at, which is going to return this blue curve. This will point to the current value. You can also put a timestamp in here if you want to look at on the 5th of May, 2010. You can also look at what the price was at that point. What I've then calculated is the number of months below. So doing a quick if-then statement: if price is below 1, if no, 0, and therefore doing a cumulative sum of that over the last little period of time. Dividing it by 30, that will give it to us in months. So we can see here that you can essentially plot out how many days price has been below where we currently are. Just a neat little trick, but it kind of shows you some of the things that, you know, I'll regularly jump into Workbench and use it to calculate things like this. You could do this for supply, you could do it for drawdowns. There's all manner of tools available for you. Right, so the other thing that's quite interesting with this inscriptions, so what we've basically seen is that inscriptions is kind of a way to embed arbitrary data into the Bitcoin network. Now, this has got some people not so pleased and many people extremely pleased. When we're kind of looking at the mechanics of what's actually going on here, people are essentially inscribing data into the witness portion of the transaction. We will touch on that in a second when we talk about mean block size, so just hold that thought for now. Now, an important note about inscriptions is that they do not require a large amount of BTC volume. Most people are using around 10,000 sats, and inscribing whatever that is, whether it's an image file, whether it's a JPEG, whether it's a movie file or a music audio file or text, inscribing that to a specific Satoshi that sits within that 10,000 sat volume. So what we're seeing is that the number of UTXOs, the number of actual UTXOs in the Bitcoin set, actually pushed to a new all-time high of 137 million this week. Now it's pulled back slightly from the peak, but you can see that this is actually the largest monthly peak that we've seen since just after the all-time high, and really back into bull market season back here in 2021, since we had this much UTXO creation. Now you can also see these periods here of UTXO destruction. This was actually during the low fee environment that we saw following FTX. A number of exchanges actually went about consolidating many customer wallets. There's obviously a lot of exchange activity going on, so they had to consolidate lots of wallets, and that actually reduced the overall UTXO size. So kind of interesting that we're looking at this. Has not got anything to do with transaction volume. This is literally looking at how many UTXOs exist within the set, and inscriptions push us to a new all-time high of 137 million. Now, one of the other interesting things that's happened as a result of inscriptions, they are using the Taproot script type. Now, Taproot, generally speaking, these, whether it's SegWit or Taproot, these things take many years. They're a very, very slow adoption process. Wallets have to be changed. People have to migrate over. People have to move cold storage coins. Other people are testing them. Applications need to be built that actually make people want to use it. So really, in many ways, inscriptions was the first time that we saw a real use case emerge for Taproot. There's going to be more down the line, but it was the first one that came onto the scene. And we can see the parabolic growth. At the peak, it was about adoption was 17.6% of all spending behavior was going on using Taproot. We have two different models here, adoption and utilization. We do have a paper that's associated with this, can help you understand the difference between those two. But clearly, you can see the explosion of inscriptions and ordinals onto the scene. In terms of overall spent output, so these are the UTXOs that are being spent and destroyed. 8.12% of all of those outputs at the peak was Taproot. But what you can also see is a very, very significant cooling down. Once we cross that 100,000 inscription threshold, the kind of initial wave certainly started to pass. So we're down here about 2.8% of all outputs using Taproot. So we are still very early in this. We have to see whether these inscriptions really do catch on. Do they start to develop marketplaces? And do we start seeing trade volume associated with them? So very, very early. We've seen the initial 100,000 wave burst. We're now at about 150, 160,000 inscriptions. We will see how this plays out over time. Now, just a little bit of a history lesson. I mentioned the block size before, and again, I would recommend you go and check out our inscriptions and ordinals research piece for more details on this. But I want to give you a quick snapshot of how the data works, because a lot of people talking about, oh, this is going to create bloat in the chain and various data assumptions, and there's a lot to discuss here. But I want to just take this only looking at block size, only looking at how much has inscriptions changed the overall average block size. So the chart that we have here in orange is the average block size in bytes. So you can see on the right-hand side here, 1.6 megabytes, 2.4 megabytes. And then we have a moving average here in pink just to kind of clean that up. Now, prior to SegWit, which activated back here in 2017, this blue curve here was the 1 megabyte limit. And you can see that we came up and we butt our head against it for a period of time. Now, following SegWit getting implemented, we were able to actually break above that 1 megabyte limit. You can see that on average, we typically held a value of about 1.5 to up to about 1.8 megabytes per block on average. Now, the reason why is that SegWit split Bitcoin transaction data into two. There's the transaction data, the addresses, the who is sending, the how many coins, the UTXOs, the inputs, the outputs, all the transaction data. And then there's the witness data, which is the cryptographic signature to actually prove that those coins work. And nodes are allowed to discard the witness data and prune it in a different way. Now, very, very simply, the more data is in the witness side, the closer a block can get to 4 megabytes. When we're looking at purely transaction data, there can only be 1 megabyte. So what we're basically seeing is that there is this kind of balance as there's more signature and witness data. which Inscriptions are essentially putting these images or these audio files inside that witness portion, it can push us closer up towards that 4 megabyte. So as I mentioned before, typically about 1.5 to 1.3 megabytes was a typical average block size. You can see in the orange here that Inscriptions have pushed us up to between 2 and 2.5. It's only been about 2 or 3 weeks, but in that range, somewhere about 2 to 2.5. So it's increased the average block size by about 1 megabyte. There's been a handful of blocks that were actually individually 4 megabytes, but overall what we're seeing here is that we've seen an uplift of about 1 megabyte, and in our ordinals paper, we do actually study what would happen in terms of blockchain size. Let's project Bitcoin out another 14, 15 years. I think it puts us in 2037. And to have a hard drive that can hold that future Bitcoin blockchain, assuming all 4 megabyte blocks, which is kind of the worst case and quite frankly impossible scenario, from here until 2037, it would still cost you $120 only to get a hard drive to store that. And that assumes that there's going to be no deflation in terms of overall technology prices. Now, remember that hard drive storage space is only one portion of it. We also have to think about node sync times and validation times. But there's lots of talk, but overall, in terms of the data footprint, basically the Bitcoin system was set up for SegWit to deal with 4 megabyte blocks. That was essentially the deal back in 2017. And it's really those other things, initial block syncs and other things that we pay more attention to. But anyway, it just gives you a bit of a snapshot as to some of the changes that's happened to the Bitcoin blockchain as a result of Inscriptions. And you can see how dramatic this actually is. Quite a significant push higher. Okay, so that's enough about the Inscription side of things. That's kind of in the on-chain activity element. I mentioned at the start that Inscriptions do not require a great deal of transaction volume. They're essentially moving around, 10,000 sats or thereabouts. Now, quite interestingly, it's lifted the on-chain activity space. We've seen active addresses uptick, we've seen transaction counts uptick, UTXOs hit an all-time high, but we have not seen a large amount of transfer volume. So this chart here, which you will also find in the supply section of our presets. This one here is in Workbench. We're looking at our supply presets. We're looking at young coin volume. So these are the volume of coins moved on a single day that were younger than 6 months. Now, bear in mind, if the same coin is spent multiple times, this will be counted every time it was spent. So it's looking at the raw transfer volume only for coins younger than 6 months. Now, these periods where we have very, very low transfer volume, you can see that we had one back here in 2014. We had one right before the sell-off event here in 2018, so a very low volatility environment. We had one in the middle of 2019 as we kind of sold off in that May, June, July period back in 2021. And now, and we're actually much lower than all of those previous instances. So even though we're seeing activity coming back in, there's not a great deal of coin volume that's on the move, which is kind of intriguing. As a result, this one here is looking at the total supply that was moved in the last 6 months. We call this the young supply, short-term holder supply. I've also put a value at formula here so we can actually track where this is and actually draw this horizontal curve. And you can see that very, very few instances. Remember, this is a binary system. Coins are either young or old. They're either short-term or long-term holder. What we're looking at here is because we're not getting a lot of transfer volume and young supply is not lifting higher, that means that those coins that are being spent down in that young supply are essentially coins that were already younger than 6 months. Because the only way for young supply to rise is when old coins get sold or spent. Because what we're seeing there is that old coins have to become young in order to increase the young supply. There's always coins migrating and maturing over that boundary into the old supply realm, but also there's some coins being spent. When that's in equilibrium, there'll be no change. If you get lots of old coins being spent, you will see an uptick in this young supply. And when does that happen? Typically during bull markets near the top, because you've got lots of old hands spending, selling, exiting their position near the top, and you've got a whole bunch of new buyers. These peaks here are new buyers, inexperienced Bitcoin holders saturating the supply. Where we are at the moment is pretty much the exact opposite. We are not seeing old hands really liquidating at any significant state. But we can actually confirm this by jumping across to look at the old supply. So we've got two traces here. In the blue is all of the coins that are older than 6 months, and in the red is all the coins older than 1 year. Now, older than 6 months is currently in the process of pushing up to a new all-time high. It's not quite there yet, but it's very, very close, about 15 million BTC. And the coins older than 1 year is now over 12.1 million BTC. So actually, no, I think it's 12.9 million BTC. Let's have a look, 12.9. And that is at an all-time high. So we can look at that young supply and say, well, it looks like old hands are not really spending. We can look at the old supply and actually confirm that and say, yes, they're actually not spending. And we're actually seeing most of their supply curves hitting an all-time high. So even though we've had a 50% rally, we still are not seeing those old hands ready to distribute just yet. Kind of shows how savage the bear has been, that people are willing to sit tight and say, not today. And the last thing we can look at is actually confirm this by looking at the old coin spent volume. Now, in this one here, I've actually applied a if-then. I've used our value at function as well, and I've applied an if statement to basically model out and put these orange lines down to look at when we've had old coins being spent at this low of a level. You can see that on a 7-day moving average, we are at a very, very low level in terms of overall 5,300 BTC per day, which, you know, typically during these bull markets, we're talking about 30, 40, 50,000. So 10x more in terms of overall coin volume being spent. And you can see that these orange bars typically show up at very, very low volatility. So at the bottom of these corrections, kind of before something changes. You can see here back in 2019, we had a rally which then sold off again. Here we had a rally that pushed us up to a new all-time high. This was just prior to FTX. We had very, very low volume. And here we are again with an extraordinarily low amount of volume. Typically speaking, what we're looking at here is that old hands slow their spending. And we can try and look into this from many layers. But in terms of very, very high level snapshot, when old hands stop spending, it's because their behavior pattern is starting to change. They're either seeing that in a bear market, for example, prices come down so low and they're like, well, I think it's probably going to rally from here, so I'm going to stop spending. Or it could be that they've just hit the point of seller exhaustion, where those old hands, there's just no one left who actually wants to spend their coins at that price. Same thing can be said back here in July 2021. So typically speaking, it shows when you get this real decline, a major decline, you're seeing a change in investor behavior. Now, the nice thing is that we can supplement this by looking at both their average cost basis. So this is looking at the, and again, this model here is also available for advanced users. You'll find it in Workbench under our pricing model presets. This is our old supply, realized price in blue, young supply in red, and the all market in orange. And what we can see at the moment is that we have, very similar to 2019, we have poked our head above the long-term holder or the old supply realized price at 23,400. So we are currently sitting above that, and that means that all cohorts on average are now back in profit. And you can see that we also have the short-term holder cost basis starting to climb. I'm going to zoom in on the last 3 years so we can see our current cycle. And you can see that we have the short-term holder cost basis starting to climb and pushing up above the realized price. So we're getting that momentum starting to kick back in. And again, it's starting to signal that there could be a bit of a change in investor behavior that is underway, particularly now that all these investors are now back into a profit on average. Now, one of my favorite models, once we've kind of established all of this, we've seen that old hands are spending less, we've seen that young hands are also spending less, it's kind of a bit of a decision point. There's something that looks like it's a bit of a regime shift could be underway. Now, aSOPR and any kind of SOPR variant, these are some of my favorite metrics to look at for this moments like this, because they're fantastic at helping us look at investor behavior and when we get these big changes. Now, for any of you who've been watching this channel for some time, whenever I'm looking at something on a bigger picture, I like to put on like a 7-day, I like the exponential moving average for SOPR variance, mainly because it's faster. It gives me a little bit more weight towards recent days, but it's also going to clean out all that daily noise. The simple moving average, sometimes you don't quite get as sharp spikes when you're looking at a metric like this. Now, SOPR is a profit multiple on coins that are spent. And for the aSOPR variant, we're looking at the entire market. So we're just looking at a full cross section. Now, something that you'll probably notice is that during bull markets, we typically bounce and find support on a value of 1. This is essentially indicating that those people who bought the top are now starting to flush out their coins. They're selling to overwhelm all the profitable coins. Those who have massive profits, because any kind of profit's going to put upwards pressure on this metric. So at the bottom of these corrections, right, at the same points in time when we see that those old hands really slow their spending, what you're seeing is that they are slowing their spending and they're no longer selling because they've seen the correction. They feel like the correction has kind of done its thing. In bull markets, a retest of 1 on SOPR generally indicates a bit of a buy the dip type mentality. It's people who have prices come back to their cost basis. People are no longer selling at a profit. The people who bought the top are essentially flushing out their coins. A nice little undercut means that those who literally bought the top are now getting flushed out. And then a strong bounce from there is a good sign. The exact opposite is true during a bear market. You can see right before FTX, we saw people come up and give me my money back. I'm selling at my cost basis. I want the exit liquidity. And we got the sell-off that followed. And there were several of these events over the course of 2022. So zooming in on our recent history, we have finally got a significant break above. We found support once, twice, and we're starting to, what we really want to see is this metric push higher. That would signify that the market is absorbing profits. There's enough demand to take that absorbed profit, and we do have a bit more positive momentum. So we've got these first initial retests. It is possible that we are on the cusp of a bit of a regime shift. We're seeing investor behavior changing. We're not seeing old hands coming back into the fore and spending their coins. We're still seeing that there's profits being locked in and the market seems to be holding it. So there's a couple of things here signifying that we could be on the cusp of a bit of a regime shift. So the last metric that we're going to touch on is one for our professional members, giving you a bit of a snapshot of a suite of 47 metrics that we released last week. And they're trying to combine 3 core components that we use here in on-chain analysis. One is cohorts, long and short term. The other one is our exchange data, which is trying to map out what is the most accurate sell side pressure that we're seeing from these different cohorts. And then also combining it with our realized profit and loss, which we find is excellent for looking at capital flows, sentiment, capitulation, profit, short-term, long-term in terms of market cycles. So really looking at kind of the micro and the macro, but combining cohorts, exchanges, and realized profit and loss. So on the left-hand side, you'll find all of these under our long-term, short-term category. We've got coin day destruction and dormancy, bringing that lifespan in for these different cohorts. We've got volume in profit and loss of these cohorts to exchanges. We've also got realized profit and realized loss, as well as realized profit and realized loss to exchanges. So this particular model that we're looking at is relative. So looking at it of all of the realized value in that particular day, how much of it was long-term holders, short-term holders, in profit and in loss. So a couple of interesting dynamics here when we're looking at the relative amount of realized loss by long-term holders. It's kind of interesting that this particular cohort tends to have their absolute peak very close to or near the bottom as cycles start to change. What we're basically seeing here is that these long-term holders are those who are essentially top buyers. They are folks from the previous cycle. They've done their 155 days. They've passed the gauntlet of time. But when they actually start expelling their coins in a loss, they're essentially doing it at the exact wrong time. It's one of these market anecdotes that you see play out over and over again. People will typically take that first exit liquidity rush, get out of their position, dominate what you're seeing in terms of long-term holder flushing out in loss. And it's kind of interesting that this tends to peak and very, very quickly decay as that investor behavior starts to change. And we can see here that we've had that peak over 57 or 58% of all losses being locked in by long-term holders on the 5th of January, and that has since declined to around 34%. So a fairly substantial decline. We've basically seen that purging of the previous cycle top buyers. When we look at our short-term holder cohort, we actually see a very, very interesting dynamic. As we come in towards late stage bear markets, you'll see that these peaks start to decline. You get this decaying off. You'll always get these capitulation style events where the losses start to dominate. But generally speaking, you'll see this decaying off, and eventually on that relief rally, as we had here in 2019, short-term holders explode back into profit. This is really describing that over time, short-term holders are buying, they're selling, they're getting flushed out progressively as the bear market proceeds onwards, and eventually a floor gets established. And you can see here that we had a very, very similar decay in our short-term holders in loss all the way down to a particular low. What we then see is that because there's been such an enormous changing of hands, so many coins have now found a new owner with a much more favorable and much lower cost basis, particularly considering we looked at the beginning how this recent kind of bottom formation we've been in was somewhere on the order of about 8.4 months. So that's enough time for all of the short-term holders to be contained within that bottom formation range. So now that we've had a significant rally higher, essentially all short-term holders are by definition in profit. Aside from the guy who literally bought the top tick, almost every short-term holder right now is in profit. So you basically get this explosive changeover where you see that those short-term holders return to a profit. Pretty much all of those long-term holders have been flushed out, and you can start to see these cycle resets. And obviously this works in both directions as well. During bull market peaks, you essentially have the largest number of short-term holders with coins near the top, and you see this rapid explosion of short-term holders in loss. It shows that massive decay of price, and a lot of people who are trapped above, or in our instance at the moment, trapped below, but trapped in a good way in terms of having a low cost basis. So please do let me know as you start to explore these new metrics. If you are looking through, please feel free to let me know if you have any comments or thoughts. This is something I'm actually currently experimenting with and exploring. So I'm as excited as I hope you are to really play around with these. I find realized profit and loss to be an exceptionally powerful technique. And particularly when we layer it in with exchanges in our cohorts, it really does give us something quite exciting to play with. So thanks everyone for tuning in. Hopefully you found that session useful. As I mentioned, pretty much everything with the exception of that last chart is available to our advanced members. You'll find many of these in our HODL Wave Dynamics dashboard. So do check that out. Please let me know if you have any other questions, and I look forward to seeing you in the next one. Cheers.